Welcome to Talk Tickers, where we break down the earnings calls that move markets. Today, we're analyzing Viant Technology's pivotal third quarter. Now, on the surface, the numbers looked a little mixed, but the market's reaction? Well, it told a very, very different story, sending the stock absolutely soaring. Let's dig in and figure out why. So let's start right there with the market's immediate verdict. The day after the announcement, Viant's stock shot up almost 20%. And get this, it was on trading volume that was 11 times the normal daily average. I mean, a move that dramatic just makes you stop and ask, what exactly did investors see that maybe the rest of us missed?
And here's where it gets a little weird, because the headline numbers, well, they don't really seem to justify that kind of powerful reaction. Sure, standard GAAP earnings per share, that was a solid beat. But the adjusted non-GAAP number, the one analysts really watch, that actually missed expectations. And revenue, it was just in line. So again, what was going on here that this simple summary is missing?
Well, it turns out the real story wasn't in those headline numbers at all. It was hiding in the underlying, or what they call their pro forma results. See, once you adjust for a couple of one-off items from last year, a much, much stronger picture of the core business emerges, one that really suggests this company is hitting a true acceleration point.
And this slide right here really shows the power of that adjustment. So reported growth was a pretty modest 7%. But once you strip out last year's big political ad spending cycle and a client that was lost because of a merger, two things that were totally outside of management's control, the underlying revenue growth was actually a super powerful 19%. And contribution ex-TAC, which is basically their gross profit, grew even faster at 22%. Now that is the kind of growth the market was reacting to.
Profitability was also really robust, pretty much across the board. Viant posted record numbers for both contribution ex-TAC and adjusted EBITDA. And they actually beat their own guidance. On top of all that, they put a ton of capital to work buying back their own shares, which is always a crystal clear signal that management thinks their stock is undervalued. So where is all this underlying strength coming from? Well, it's not just happening by accident. It's the direct result of a really focused strategy to build what they call an autonomous advertising platform for the open internet. And it's all centered on two incredibly powerful growth engines, AI and connected TV. And here you can see the engine room of their growth. Connected TV, or CTV, hit an all-time high, and now it makes up almost half, 46%, of all ad spend on their platform. And listen, this isn't just about riding a wave. This is a direct result of Viant's deep integrations with publishers and its pretty unique targeting capabilities in what is, by far, the fastest-growing part of digital advertising. The tech backbone for all this is their Viant AI product suite. 3 of the 4 phases are already live and running, with the AI bidding engine alone automating a massive 85% of all ad buying. The final piece of this puzzle, AI decisioning, is set to launch by the end of the year. And that promises to fully automate campaign optimization. We're talking about a potential game changer for efficiency. At the same exact time, Viant is building a pretty significant data moat around its business. Their patented household ID is a huge advantage, especially as third-party cookies start to disappear. By identifying users at the household level, it gives advertisers way more precision and reach than their competitors. It's really about future-proofing their whole targeting system. And this entire strategy, you've got the AI, the CTV focus, the data moat, it all just landed a massive, real-world validation. Viant announced a flagship, multi-year partnership with Molson Coors. And this isn't just another client win, okay? This is a huge blue-chip brand giving Viant its stamp of approval, basically validating the entire platform as a go-to for major enterprise advertisers. But, to really appreciate how significant this quarter is, we have to zoom out for a second. We have to put all these positive developments into the context of the stock's recent and, let's be honest, pretty painful history for investors. So even with that 20% pop, the stock has been a dramatic laggard. Over the past year, it has underperformed its software peers by more than 70 percentage points. And this context is absolutely key. It helps you understand why such a positive surprise could ignite such a strong rally from what was a really depressed base. You see, this underperformance really masked a year of quiet but incredibly effective execution. While the stock price was struggling, underneath the surface, the company was busy making strategic acquisitions, winning awards for its AI, expanding key partnerships, and laying all the groundwork for that landmark Molson Coors deal.
So this all brings us to the central question for anyone looking at Viant today. Was this quarter just a one-off beat, maybe helped by some easy comparisons? Or is this a genuine, durable inflection point for the business? So what's our take on that big question? All right, now we're going to lay out our thesis, give you our rating, and our prediction for what you should be watching for in the next earnings call.
We are initiating a rating of outperform on the stock.
Our outperform thesis really rests on four main pillars. First, growth is clearly accelerating, and the guidance they gave points to that sustained 20% level growth and expanding margins. Second, that Molson Coors deal, it provides crucial enterprise validation, and it really de-risks their whole strategy. Third, there's a major product catalyst coming right around the corner with the AI decisioning launch. And finally, the company is just perfectly positioned to benefit from two massive industry tailwinds, the huge shift to CTV and, of course, the end of the third-party cookie. So what are we looking for in the next earnings call? Well, we expect Viant to hit the high end of their revenue guide, probably thanks to a strong holiday season. And we expect them to beat their EBITDA forecast as that high-margin CTV business really starts to flex its operating leverage. We believe the stock is going to continue its upward re-rating as the market starts to reprice this company, not as just another cyclical ad tech player, but as a durable AI-driven growth story. And as always, just a final reminder, this analysis is for informational purposes only. It is not financial advice, so please be sure to do your own research.